Hello and welcome to another episode of Full Court Finance here at Zacks. I'm your host, Ben Rains, and today we're taking a look at a few beaten down growth tech stocks to see if they're worth finally considering buying after a prolonged sell-off that's continued heavily in 2022. But before we get into everything, remember to subscribe and leave a review wherever you listen to your podcast, and make sure to check out our Zacks.com/promo page for a look at some of our services, portfolios, and more. So before we jump into these two growth-focused tech stocks, I quickly want to break down the market to give a better sense of why it might be time to consider these two names. So stocks tumbled to start the first full week of March on Monday, with the Dow down about 2.4%, the S&P 500 down 3%, and the NASDAQ down about 3.6%. The market was a bit more tame on Tuesday, with things opening slightly lower, and then we saw a big reversal around midday. The last time I looked, the NASDAQ was up about 2%, the S&P 500 was up about 1.6%, and the Dow was up about 1.6% as well. So we did see some buyers step in as things got a little overheated to the downside, and we'll go into maybe why you might see some more buyers continue to step in. So the S&P 500, as of this morning, had fallen around 13% from its records as Wall Street remains focused on the escalating Russian invasion of Ukraine. There's been no ceasefire agreements yet, and investors are weighing the possibility of even heavier sanctions on Russia, including finally that crucial oil and energy sector. And now the longer the fighting goes on, the more likely Wall Street will start to focus on the potential for a far larger conflict ahead. In taking a look at the larger 2022 downturn in volatility, investors don't, though, appear to be in full panic mode about that Russia-Ukraine situation just yet, with the benchmark index down just around 3% below its late January lows, which was weeks before the initial Russian attacks. The tech-heavy index is also now on the cusp of entering bear market territory, down roughly 20% from its November records. Thankfully, though, Wall Street has proven it's willing to buy strong stocks they feel are trading at discounts, and the index has seen 12 months of gains essentially washed away already, significantly recalibrating valuations. In fact, the NASDAQ is sitting at levels that it last saw near the end of 2020. And the S&P 500 is trading around where it was last April, with valuations now at pre-COVID levels. So the S&P 500 is trading at around 18.6 times forward 12-month earnings, which is below where it was in the early part of 2020, so before the initial COVID sell-off, and around its median between 2015 through early 2020. So right back to much more reasonable valuation levels, with essentially lots of these big pandemic high flyers losing almost, in many cases, almost all of their COVID related gains. So you will start to see investors likely step in and buy more and more of these names as longer term holds, just simply because some of the selling appears to be overdone, with, as we mentioned, nearly 2 years worth of gains wiped out in many cases. So back on the interest rate front, the conflict has caused Jay Powell to take a bit more of a dovish turn last week. The Fed chairman said that he supported a 25 basis point hike of its core interest rate at the mid-March meeting instead of 50 basis points. Clearly, there's no guarantee that Powell and the Fed won't raise by 0.5% to help combat 40-year high inflation. That said, no matter what happens, interest rates should remain historically low for years to come, and this will leave many on Wall Street chasing returns in stocks, especially when we consider where inflation is at the moment. Let's also remember that the U.S. economy has flashed signs of strength, and longer-term buyers might start considering buying and holding names, even these growth-focused names that we're going to talk about that have been hammered over the last several months and to start 2022. So the first stock that we're taking a look at is Shopify, which trades under the ticker SHOP, S-H-O-P. Shopify was a Wall Street star long before the pandemic, and businesses of all stripes turned to the company for all things e-commerce. But it has tumbled since hitting records in November, and it fell further following its Q4 release in mid-February as Wall Street sold the stock on slower growth forecasts. But before we get to that, let's quickly review what Shopify does. So Shopify provides what it calls the essential internet infrastructure for commerce. This includes everything from site design and marketing to payments and shipping. It does all things e-commerce. Shopify makes money from recurring subscription fees and tons of various add-ons that help run many other core business functions. Shopify has also bolstered its point of sale products offerings, and software have gained momentum on that front while helping create a unified approach between in-person and digital. It closed 2022 with nearly 2.1 million merchants on its platform in nearly 125 countries around the world. The company also offers various tiers, some to even entrepreneurs and small businesses, as well as higher volume merchants, so expanding its reach certainly. And Shopify, Amazon, and countless other digital commerce companies have tons of growth runway since e-commerce is still accounting for just around 13% of total U.S. retail sales, and this is as of Q3 of 2021, the most recent hard data I could find. And that's up from just around 10% in 2019. So plenty of more room to grow as businesses need to be able to do digital and in-person and everything. People just want convenience wherever they can. So more recently, Shopify beat our Q4 estimates, and its total FY 2021 revenue climbed about 57% to $4.6 billion, and its adjusted earnings were up 61%. This top-line growth compared to 86% top-line expansion in 2020, and an average of about 67% between FY 16 and FY 19. So plenty of growth before that as well, before that big pandemic boost. Looking ahead, Zacks estimates are calling for another 31% revenue growth in 2022 to climb from $4.6 billion to $6.1 billion, and then another 32% growth is expected in 2023, all the way to see it hit $8 billion in total revenue. Percentage-wise, obviously 2022 is marking a significant slowdown in terms of that year-over-year growth. Still, the company is expected to add $1.5 billion to its top line, or roughly its total revenue in all of 2019. So it just, as the numbers get bigger and bigger, that year-over-year growth percentage is going to get harder and harder, but still it's growing at a really impressive rate. On the earnings front, its earnings are projected to pop another 7% this year and then climb another 43% next year. We should note that some investors in Wall Street were nervous, obviously, about that slowing growth, and they're also maybe a little hesitant that the company is going to spend a little bit more money than it's has in the past. The company said it's focusing on improving its fulfillment network, and its goal is to be able to help more of its customers reach two-day affordable shipping goals and just build out that network as everyone tries to chase Amazon and Walmart and Target, and everyone under the sun is trying to be able to offer as quick of delivery as possible, and building out more fulfillment centers is a big part of that. The company said it expects capital expenditures of $200 million in 2022, which would outpace spending on physical assets from the previous 2 years combined. So with that in mind, the company also said it plans to spend roughly $1 billion over 2023 and 2024 on leasing warehouses and hubs throughout the U.S. to ramp up its ability to compete in this booming e-commerce space. And this is just something it has to do for its growth. Shopify's 2022 and 2023 earnings estimates have trended slightly lower since its last report to help it land a Zacks rank number 3 at the moment, number 3 hold. And in terms of price movement, Shopify stock skyrocketed from $70 a share back in 2017 to $1,700 in November, and it's really fallen off a cliff since then. Its shares have tumbled about 70% since then. It's currently sitting at around $543 per share, which is right where it was before its initial post-COVID sell-off surge began. So essentially where it was in late April of 2020. As we mentioned, a lot of these growth names have lost nearly 2 years worth of gains, all those post-pandemic gains. Shop's forward PEG ratio, which is its PE ratio divided by its growth rate, is now at 4.2, which is down from a whopping 66 last April, and well below its median of 34 over this past 12 months. This compares to about 2.2 for Amazon Etsy's 1.4, and the broader internet services market's 1.1. And it marks new lows for the last year of Shopify as well. Obviously, it's still a very big growth-focused company, and its valuation might be a little too rich for some, but it's come down significantly and it's starting to look far more reasonable. We should also note that the company has a really strong balance sheet that supports an array of possibilities going forward, including jumping into new areas of e-commerce and new digital commerce areas that maybe we don't even know of or couldn't imagine at the moment. This includes $7.8 billion in cash and equivalents and marketable securities, with $13.3 billion in total assets against just $2.2 billion in liabilities. So if you're a longer-term growth-focused investor, you might want to consider Shopify, and Wall Street might start nibbling on the stock sooner than later. As we just mentioned, it's especially if it falls any further. It's lost almost 2 years worth of gains already, and there's always the possibility of a stock split going forward because that $543 price tag is still a bit unattainable for many retail investors. So there's always the possibility that they do things that Apple and many other companies have done before, which is to split that stock to make it more attractive to the average retail investor, which could then make it more attractive to Wall Street in general. Obviously, that's just speculation, but it's a possibility for sure for Shopify. So overall, certainly worth considering Shopify. Dive a little deeper. Maybe you add it to your portfolio as a bet on these big growth names that have lost so much of their gains over the last year and a half, at least, to add to your longer term portfolio as they come down to more reasonable valuation levels. And now we're going to look at the second of our two stocks today, and that is Square, which trades on the ticker SQ, but we're now calling it Block. The company changed its name to Block back in December. For various reasons, they're saying they're far more than just those little tiny white devices that were used to scan credit cards and debit cards from iPhones a decade ago. So they changed their name. It's now Block, still trading under the ticker SQ though. So if you hear me say Square, I apologize, but the company's called Block. The company started over a decade ago by selling, as we just mentioned, those tiny little credit card readers for small businesses and entrepreneurs and people just at farmers markets and things like that. And they've expanded greatly ever since that. So that today the company's at the forefront of the ever-growing fintech industry, and its sights are set on becoming a really all-encompassing fintech player, a neo bank, whatever you want to call it. The future of money is what they're all in on. Block is light years beyond that firm that sold those smartphone and tablet connected credit card readers. Its portfolio today includes those point of sale offerings, broader payment software, infrastructure, business loans, peer-to-peer payments, Bitcoin transactions, and far more. The company, as we mentioned, is aiming to just become a modern new age bank. This includes its efforts to expand into that peer-to-peer payment services, which is really popular. It's Cash App, so that competes against PayPal and other offerings from big companies like JP Morgan. The company is also working to include e-commerce players that we've talked about, like Shopify and Etsy. And the customers are doing far more digital payments, as we just mentioned. Friends, family paying each other. That Cash App is really important. The company is also allowing people to buy and sell Bitcoin on the Cash App, buy stocks, ETFs. Square's ability to attract that younger generation of investors and compete against the likes of Robinhood could offer huge long-term upside potential. Block is also clearly well on its way to becoming a holistic financial services firm for both consumers and businesses to keep, spend, and invest their money. And then back in August, the company announced its entry into the fast-growing buy now, pay later space with its planned acquisition of Afterpay in an all-stock deal that was valued about $29 billion. And that deal officially closed at the end of January of this year, so just about a month ago. Afterpay is one of the leaders in the short installment payment space for e-commerce shoppers to purchase things and then space them out into various payment spaces. Afterpay boasts At the time, it boasted around 16 million customers and nearly 100,000 merchants globally. That buy now, pay later space is booming, and various fintech firms are offering the ability to make smaller payments on sites that include everything from Home Depot to Nike, and it's a very popular thing now. Square hopes that the integration will help even the smallest of merchants offer buy now, pay later at checkout, and give Afterpay customers the ability to manage their installment payments directly in the Cash App, and then give Cash App customers the ability to discover merchants within the app as well. So just bringing more things in-house and broadening their scope. The company also has various partnerships with other companies, including TikTok, where it's a widely popular social media app that competes against Instagram and other places, and they're enabling sellers and to essentially, if you see something you like on TikTok, to be able to buy it from their online store. It's a little more complicated than that, but that's the basic plan. So lots of various things. That's why they changed the name to Block. They're a holistic fintech company. They just completed their addition of Afterpay. So now we're going to go on to their growth and what they've done in the last few years, and then looking ahead as well. So Block steadily expanded its revenue since its late 2015 IPO. And then it had a booming year in 2020, driven by the overnight need for digital payments and e-commerce. It was the best showing in the company's public history. Its sales skyrocketed 102% to $9.5 billion. The company then posted 86% revenue growth in 2021, which it doesn't include any of Afterpay, to reach $17.6 billion. So it's gone. The last 2 years have been a huge boom for the company. Meanwhile, its adjusted earnings climbed 104% to $1.71 per share. So if we look back to 2019, the company posted $4.7 billion in revenue, and they just did in 2021 $17.7 billion in revenue. So massive jump over the last 2 years. The company also topped their Q4 earnings estimates on February 24th, posting a solid end of the year of 2021. That said, its earnings estimate revisions have trended in the wrong direction. That's a part of the reason why it hasn't done significantly well following that beat for Q4, with its 2022 and 2023 consensus estimates trending just in the wrong direction as they spend on various new endeavors, as we mentioned with Afterpay as well, even though the company beat by 42% this past quarter on the bottom line as part of an impressive stretch besides Q3 where the company pretty much always beats by a big percentage. So looking ahead overall, the company's 2022 revenue is expected to slow down significantly compared to what they've done over the last 2 years, jumping just by 7% this year to about $19 billion. But as I mentioned, they've gone so far so fast that a slowdown in revenue was to be expected. And obviously this has been priced into the stock significantly already. And then if we look ahead to 2023, we're calling for another 28% revenue growth all the way up to $24 billion. So just a massive jump in a short period of time. And then on the bottom line, we're calling for a pullback in 2022, with its adjusted earnings expected to decline by 36% to $1.09 per share. But then we're expecting in 2023 for that figure to bounce back up to this past year's levels of $1.73 per share. So a big bounce back after what we're calling for as a near-term slowdown on its bottom line. With that in mind, as we just mentioned, the reason the stock is down 62% is because the growth was going to slow. Things are changing. It got a little out ahead of its skis in terms of the stock price, as a lot of these big growth focused names did in that Wall Street exuberance for months and months and months. So the stock's down 62% from its August records, and it did pop 7% through early afternoon trading. The last time I looked, it was trading around $104 per share. And if we look more broadly, the stock is still up over 500% in the last 5 years to blow away its industry's average. And if we look, as we mentioned with both these stocks, the stock is now trading at one point where it was nearly in the fall of 2018. The stock because the stock traded roughly sideways for the better part of a year and a half, almost 2 years before that initial COVID bounce back saw it return to new highs, where it continued to post new highs for a long time until it started falling from its August records. So despite that pullback, it's still at 500% over the last 5 years, but now it's sitting 62% below those August highs. Wall Street also remains largely high on block, with 19 of the 28 brokerage recommendations that Zacks has at strong buys, with 4 more buys and then nothing below a hold. Block currently lands as Zacks ranked number 3 hold, though, at the moment, and is trading at a roughly 120% discount to its current Zacks consensus price target of $229 per share. So Wall Street still sees plenty of upside for the stock, and that's just in the short term. And longer term investors might want to consider adding it as a bet on fintech and the digital money future, all things digital money and online payments. Its valuation is still pretty out of whack if you just look at anything to do with earnings. That said, it's still a very growth-focused company, which many other companies have been before, Amazon included, where people just aren't going to look at PE ratios or even PEG ratios. So in terms of trading at forward sales, it's trading at essentially its lowest points over the last 5 years, right almost at the lows of the COVID lows, that sell-off, and then back right around where it was in 2017. So it's trading at 2.8 times forward 12-month sales, which is a big discount compared to its broader industry, and way, way below its highs over the last year and a half. It was trading at as high as 11.3 times forward 12-month sales. So you could see that a pullback was needed when those valuations just get so out of whack. So if you're a longer-term investor, you might want to consider either Block or Shopify, with their stocks just being pummeled and pummeled and pummeled in the latter half of 2021 and then to certainly start 2022. So that does it for another episode of Full Court Finance. Until next time, I'm your host, Ben Rains. And remember, if you have any questions, please feel free to shoot us an email over at podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.